It's happening again. Another business where guidance disappoints investors and Wall Street punishes the stock with fury. China is again the main focus post-earnings, and this time it feels like a slowdown is real. Applied Materials is getting punched in the face right now. Is the growth story coming to an end? Welcome to the Quality Investor. Applied Materials delivered a strong quarter. It came in better than estimates on both the top and bottom line, and in fact, booked a record quarter for revenue. On a sequential basis, we saw acceleration in revenue growth. Yet, the market doesn't care. As investors, we must always be mindful of this maxim. Markets are forward-looking. The market doesn't care what you have done, it cares about what you will do. And Applied Materials issued a dire prognostication about its Q4 revenue that sent shockwaves through the stock. And in my estimation, this is the first tangible evidence we have of the ongoing trade war with China cutting into future earnings for this chip equipment manufacturer. Today, we are discussing the warning Applied Materials gave investors and what it actually means. We'll also quickly peruse the formidable results of this quarter, and I'll provide my assessment of whether or not this business is even worth adding to, either as an increase in a position or a new buy entirely. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Quote, "We are expecting a decline in revenue in the fourth quarter driven by both digestion of capacity in China and non-linear demand from leading-edge customers given market concentration and fab timing." End quote. That was the quote from the earnings release that sent the stock spiraling downward. But what does this mean? And is it an investment thesis altering event? This incredible piece of corporate speak essentially means China trade is uncertain given the geopolitical climate. So we're not even going to guess as to what might happen. That's a simplification. However, the first part of the quote, digestion of capacity in China, alludes to the cyclical nature of the semiconductor industry on the whole. China, AMAT's largest customer, produces many chips, but they still have a focus on older tech chips. Their investment in fabs and by extension purchases from Applied Materials have expanded their ability to produce these chips. But this increased capacity means oversupply of chips. Either that or underutilization of capacity until demand catches up to the new capacity. So China is running current fabs at lower capacity as well as selling off built-up inventory. This is a very specific issue to China as their orders from Applied Materials have been paused in order to deal with this issue. The long-term thesis for AMAT is centered around AI-related chip production. These have the most cutting-edge technology and are what will drive growth for Applied Materials over the next decade. It is also evident on the shift in geographic sales mix for AMAT away from China and more towards Taiwan and Korea. These two countries focus more on the advanced chip fabs, while China, like I said prior, produces older generations of chips. That said, this is where guidance also disappointed. Last quarter, there was optimism for leading-edge chip production. On the earnings call, Applied Materials said there was 100% utilization, demand was very strong, and CapEx spend at cloud service providers is expanding. The response to this was to create a linear order ramp that would accelerate orders through 2026. The issue is that they're not seeing that pattern develop for Q4. And that is what was meant by the non-linear demand part of the quote. Applied Materials is seeing uneven demand, which they are attributing to businesses waiting longer to make capital commitments given the uncertain trade environment, and especially in Asia. This is similar to Fortinet. Another reason is customer concentration. They mentioned one customer being larger than others, and therefore demand attached to their ramp. It definitely seems like they're referring to Taiwan Semiconductor. Long-term, however, Applied Materials expectations remain unchanged. And that is the key point. We take the long-term view on this channel for investing, and AMAT remains a key component in providing leading-edge equipment necessary to drive AI growth going forward. The China and trade issues are a short-term headwind. We might see uneven sales guidance the next few quarters, but ultimately, this will not affect long-term growth in advanced tech. So, let's look at the earnings and assess what Applied Materials' intrinsic value is now that we can incorporate this China uncertainty. Applied Materials is trading at $161.94 at the moment and has taken quite a big hit today in the market. You can see it's down drastically, nearly 14% since the earnings was released yesterday. And this comes after a very nice ramp up since those April tariff woes, as Applied Materials was steadily climbing, nearly hitting $200 a share, but the guidance was disappointing and the market is reacting seemingly with a vengeance. The earnings themselves were actually quite strong. We saw record revenue of $7.3 billion. That was up 8% year over year. That beat estimates of about $7.21 billion, and we saw a GAAP operating margin of 30.6%, which is actually an expansion year over year from 28.7%. GAAP earnings per share was at $2.22, and non-GAAP earnings per share was at $2.48, which exceeded expectations of about $2.36 per share. So the earnings themselves were a very nice beat. We saw some very nice growth. And coming down to the segment section, we see strong growth here as well. So the revenue for semiconductor systems was at $5.42 billion, up from $4.92 billion a year ago, which was 10% growth year over year. And sequentially, as I mentioned, acceleration from the 7.2% growth we saw last quarter. However, Applied Global Services actually saw kind of a slowdown here. So $1.6 billion in revenue, up from $1.58 billion a year ago, only 1.3% growth year over year, and slowed down from last quarter of 2.4% growth. We also saw a contraction in the operating margin here at 27.8% versus 29.6% a year ago. One positive aspect of AGS is that core services revenue, mainly subscription revenue, grew 10% year over year. However, this was offset by a steep decline in sales of their 200mm equipment, and that dragged the overall segment growth downward. And with capacity underutilization ongoing in China, this also provided less of a need for maintenance services. Looking at the cash flow statement, there are some nice things to take away from here. $2.6 billion in cash provided by operating activities, up from $2.4 billion in the quarter a year ago, although they are down year to date at $5.1 billion versus $6.1 billion 1 year ago. From a free cash flow perspective, it's also hurt by higher capital expenditures. So we're seeing elevated CapEx this year, approximately $1.5 billion in CapEx so far 9 months year to date, which is an 88% increase year over year from the $783 million 1 year ago. The capital expenditure has been significantly higher because of major investments in new research and development facilities to accelerate innovation in semiconductor manufacturing. And this includes a build-out of the Equipment and Process Innovation and Commercialization Center in Silicon Valley. This is described as the world's largest and most advanced facility for collaborative semiconductor process technology and manufacturing equipment R&D. So they're investing in more advanced tech, really not a huge red flag here in terms of CapEx. It's going to hurt their free cash flow here in the short term, but Applied Materials has a nice track record of delivering high ROIC. So we should see significant payoffs from this investment in the coming years down the line. Of course, post earnings, everyone was talking about the guidance, or rather the very disappointing guidance. We can see that they're guiding $6.7 billion at the midpoint for revenue in Q4. This is plus or minus 500. So if they hit that high end, that would be $7.2 billion, which would still be a decline sequentially in revenue. But Wall Street was expecting somewhere around $7.33 billion in revenue. Essentially, Wall Street was expecting sequential growth in revenue. and Applied Materials certainly underdelivered here. This also directly affects their diluted earnings per share, a $2.11 guide at the midpoint, whereas Wall Street was expecting $2.39. So this underwhelming guidance certainly contributes today to the nearly 14% fall in Applied Materials shares that we're seeing. This Reuters article explains the disappointing guidance. Applied Materials forecast hit by China pause, export license woes, shares down 13%. The article states that Donald Trump's ongoing tariff negotiations and certain export restrictions to China have made it more difficult to forecast where the economy is headed, weighing on new orders for chip-making tools suppliers such as Applied Materials. Dutch firm ASML, the world's biggest supplier of chip-making equipment, had warned earlier in July that it may not achieve revenue growth in 2026 as chipmakers building factories in the US await clarity on potential impact of tariffs. And then, of course, the quote here, we are expecting a decline in revenue in the fourth quarter driven by both digestion of capacity in China and non-linear demand from leading edge customers. And that was from Applied's CFO, Bryce Hill. So these tightened export controls on advanced semiconductor manufacturing equipment in China prevent these companies from selling their most cutting-edge tools to Chinese customers. And that's why Applied Materials is focusing so much on the older generation of chip-making equipment. In addition to that, China chip makers are now pausing new equipment orders to absorb recently added capacity for older generation mainstream chips used in autos industry and other everyday electronics. And this analyst notes here that many peers have shown surprising China's strength and given expectations for a decent pullback, but Applied Materials results show much more volatility. And another aspect that hurt Applied Materials guidance was this right here. Applied said its quarterly forecast assumed no approvals for its pending US export license applications. So because of that, they're expecting no new equipment based on these export licenses to be purchased in Q4, which is definitely hurting their revenue guidance. But like I said, all of this, in my view, is very short term. It should work itself out over the next few quarters as the Trump administration signs more trade deals. And while it's taking longer than what some people are hoping for, something will get done with China on trade. But of course, I'm not making any guesses as to what will happen there. My estimates over the next 10 years for Applied Materials are here. We have the semiconductors systems segment. On a bear case, I have it growing at 6.2% up to 8.4% on the bull case. The 5-year CAGR here is at 17%, so a significant slowdown over the next 10 years in the growth here. Basically, I'm being very conservative. And I also lowered my year one growth estimates given the new guidance. And Applied Global Services has seen 10% CAGR over the last 5 years, but I'm only forecasting 4.9% on the bear case up to 9.5% on the bull case. The other two segments are very small and we won't touch on them here. So year one estimate for revenue now is at $28.7 billion. I had it forecasted at over $29 billion for last quarter. So a little bit of a decline there, but the real acceleration in revenue is not expected to occur until 2026 anyway. Operating margin, on the other hand, still remains very strong. And like I said, we saw that operating margin expand year over year. On the bear case, I have operating margin at year 10 of 32%, 33% for the base case, and up to 34% on the bull case. So I am expecting margins to continue to rise over the next 10 years. From a free cash flow margin perspective, on the bear case, I have it at 22.2% there, up to 27.5% on the bull case. If you look at what I'm projecting here for free cash flow conversion, 85 cents on the bear case, up to 95 cents on the bull case. I should note historically, free cash flow conversion on a 10-year average is at about 97 cents. So these numbers aren't in any way wildly out of control. We're at $161.80 right now in the market with a PE of 19.3, so it has come down a little bit. It's just a tick above their 5 and 10-year average of the PE. The forward PE is at 20.3, which is above their 5 and 10-year average. The market, however, is now only forecasting 4% free cash flow growth over the next 10 years based on a reverse DCF, given that $161 price in the market. My base case has free cash flow growth growing at 5.7% over the next 10 years. So I'm not forecasting any wild growth in free cash flow here, but as you can see, that still leads to some pretty healthy DCF valuations. On a bear case, I have it $184.85, $225.17 on a base case, and $278.13 on the bull case. Applied Materials does pay a very nice dividend. It's actually up 24% from last year, and I'm estimating 13% growth in the dividend on the bear case, up to 16% on the bull case. They have a very low free cash flow payout ratio. It's at roughly 22%, so there's a lot of room for that dividend to grow, and they've committed to 80 to 100% free cash flow return to investors, either via dividends or share buybacks going forward. So the bear case dividend discount is at $202.43, $242.58 on the base, and $296.62 on the bull case. For the exit multiple, I have that at $255.69, and that's based on comps of ASML, Lam Research, KLA, and Teradyne. So you can see there's pretty significant upside now for Applied Materials in the market, and I tend to agree. I think this is a very good stock to buy at this point. The overreaction doesn't surprise me a whole lot, given that the market has been very negative towards businesses in this quarter that aren't guiding to Wall Street expectations. But to me, this provides a pretty good opportunity to buy. So I have a buy price without any margin of safety at $239.60. And with a 20% margin of safety, that is $191.68. So even the last couple of weeks, we've been hovering right around a 20% margin of safety for Applied Materials. In fact, this is a bit lower than what my $195 price target was last quarter, and now have it at $190. So even with a 30% margin of safety, we are now below that buy price of $167.72. I mentioned that I believe this is very short-term headwinds for Applied Materials. So scooping up some shares at this price could pay some nice returns over the next 5 to 10 years. And once we get out of this trade uncertainty and businesses have a little bit more clarity in what their spending will be heading into 2026, a lot of businesses are going all in on AI, and that's only going to accelerate purchases for the advanced equipment that Applied Materials makes to support AI-driven data infrastructure. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.